In April 1938, prisoner 94,835 entered Sing Sing. He had been president of the New York Stock Exchange. 9 years earlier, Richard Whitney had walked across the exchange floor and placed the banker's most conspicuous bid on Black Thursday, 25,000 shares of U.S. Steel at $205. The order made him a symbol of Wall Street confidence. But while Wall Street trusted him, and while he defended the exchange as a perfect institution, Whitney was using securities entrusted to him to keep a failing firm alive. The collapse became public on the morning of March 8, 1938. At the opening of trading, Charles Gay, the sitting president of the exchange, stood at the rostrum and announced that Richard Whitney and Company had been suspended for insolvency. The name belonged to a man who had occupied the presidency for 5 terms. Whitney was still a governor of the exchange. He still sat on its law committee. He was still a trustee of its gratuity fund. That morning, his firm and its general partners filed for bankruptcy. The institution that had treated Whitney as one of its guardians was now announcing that it could not trust his firm to open for business. The speed of the final collapse made the scandal look sudden. It was not. So the real mystery is not simply why Richard Whitney stole. It is how the man at the center of Wall Street could keep doing it inside an institution that claimed it could police itself. And what had to change when the club finally discovered that its most trusted face had been spending trust like money. To understand the protection around Whitney, return to October 24, 1929. Black Thursday did not begin with a single dramatic crash. It began with selling that fed on itself. Prices dropped, telephone lines jammed, orders arrived faster than they could be recorded, and the ticker fell so far behind that no one on the floor could be sure where the market really stood. Outside the exchange, a crowd gathered on Broad Street. Inside, brokers who were accustomed to noise began to sense something more dangerous than noise: the loss of any shared belief that a buyer would appear. Leaders of the largest banks met at the offices of J.P. Morgan and Company. They agreed to assemble money for a visible support operation. But the money needed a man on the floor, a man whose presence could turn a purchase into a message. They chose Richard Whitney, then vice president of the New York Stock Exchange. Whitney moved through the crowd to the post where U.S. Steel traded. The stock had recently sold below $200. Whitney announced a bid for 25,000 shares at $205, more than $5 million in a single, deliberately conspicuous order placed above the current market. Then he moved on to other leading stocks and placed similar support bids. The price was part of the performance. A quiet order at the lowest available price would have looked like bargain hunting. A large bid above the market said that the banks were willing to put a floor under important companies. Every broker near the post could carry that message to another part of the room, and every report leaving the floor could carry it outside. Whitney was therefore buying 2 things at once: shares for the banker's account and time for confidence to recover. This was not a secret rescue. Secrecy would have defeated its purpose. The bankers wanted traders to see that large buyers had arrived, and Whitney performed the message in the most public room in American finance. For the rest of that day, the panic eased. Prices recovered from their worst levels. Newspapers and later histories fixed on the image of Whitney crossing the floor with calm authority while everyone else seemed to be running. But he had not ended the crash. The market fell again the following Monday, and then far more violently on Black Tuesday. The depression would not be stopped by one pool of bank money or one theatrical order. What Whitney saved was temporary confidence. What he gained was something more durable: a reputation for courage under pressure. That distinction matters. The support bid was real, and it did help reverse the panic that day. The crime story comes later, but the rescue image changed the way people interpreted everything that followed. When Whitney spoke, he did not sound like an ordinary broker protecting his own interests. He sounded like the man who had stood between Wall Street and chaos. The order lasted minutes. The authority it gave him lasted years. Whitney had been prepared for that role long before Black Thursday. He came from a prosperous New England banking family. He attended Groton and Harvard. His older brother, George Whitney, became a partner at J.P. Morgan and Company. Richard acquired a seat on the New York Stock Exchange while still a young man and built a brokerage firm under his own name. On Wall Street, those facts formed more than a biography. They formed a credential system. The exchange was a marketplace, but it was also a membership club. A seat carried access, income, social standing, and a presumption that the man who held it understood the obligations of the institution. Relationships were not separate from business. They were part of the infrastructure through which business moved. Whitney looked as if he had been designed by that infrastructure. He knew its families, its committees, its customs, and its language. When the bankers needed a representative in 1929, they did not hire a public spokesman. They sent one of their own. His firm also held a prestigious position in the market's plumbing. Richard Whitney and Company handled important bond business, including orders associated with J.P. Morgan and Company. Whitney chaired the exchange's Business Conduct Committee before becoming vice president and president. The offices that should have made him legible to supervision instead made him appear to embody supervision. By the early 1930s, questioning Whitney could feel uncomfortably close to questioning the exchange's own judgment. The New York Stock Exchange also governed itself. Members wrote rules for members. Committees examined conduct. The governing committee could investigate, suspend, or expel. The system had genuine strengths. Member firm failures were not an everyday event, and many brokers treated customer property with care. But supervision still depended heavily on questionnaires, limited examinations, committee discretion, and the belief that a man of standing would tell the truth about his own condition. A balance sheet can be checked, a security can be counted. A trusted name discourages the next question. Whitney became president of the exchange in 1930 and remained in the office through 5 annual terms. Those years turned the crash into a political fight over who should control the securities markets. Senate investigators exposed pools, conflicts, preferred deals, and practices that had been protected by Wall Street's privacy. Reformers wanted federal power over exchanges that operated across the nation but answered first to their own members. Whitney became one of the exchange's leading defenders. He argued against the emerging federal regime. He warned that proposed controls could damage markets. And during the stock exchange investigation, he described the New York Stock Exchange as a perfect institution. The phrase expressed the old system's deepest belief, that the exchange could correct its own abuses because its leaders had the knowledge, incentives, and honor to do so. Congress passed the Securities Exchange Act in 1934 and created the SEC anyway. The new agency did not replace the exchange's daily governance. American market regulation became a shared structure: federal authority outside, self-regulation inside. Whitney's scandal would test whether either side could see through the exchange's prestige. But the contradiction had already begun. The SEC later traced a misuse of entrusted securities to 1926. It said the practice became regular in 1930, the same year Whitney began his presidency. This was not a successful leader who retired, suffered one late disaster, and suddenly crossed a line. The misconduct grew alongside his authority. The perfect institution had placed its strongest public defender inside its own blind spot. Richard Whitney and Company was a brokerage firm, but the SEC concluded that its collapse came largely from activities outside normal customer brokerage. The report listed a collection of ventures that sound less like the work of Wall Street's chief guardian than a cabinet of speculative hopes. There was the Florida Humus Company. There was the Colloidal Products Corporation of America. There was the Distilled Liquors Corporation. There were securities positions and other commitments that required new money long after they had failed to produce enough of their own. The names are almost comic. The consequences were not. Money that should have supported the brokerage business drained into outside ventures and personal obligations. When an investment needed another loan, Whitney found one. When that loan came due, he found another source. His firm did not collapse because ordinary customers suddenly demanded something impossible. It collapsed because the name Richard Whitney kept attracting money after the economics underneath that name had stopped working. The criminal cases that later sent Whitney to prison involved securities held in fiduciary roles, property he was supposed to protect, not spend. Contemporary coverage connected the indictments to securities associated with his wife's trust and the New York Yacht Club, where Whitney had served as treasurer. The full list of accounts was larger, but one fact controlled every version of the story. The property had been entrusted to him. That word matters. Entrusted means the owner had transferred possession without transferring ownership. Whitney had access because somebody believed he would act as custodian. The theft began when he turned that access into cash. Whitney borrowed from banks, brokers, friends, relatives, and institutions inside his social world. J.P. Morgan & Company made his firm a $500,000 unsecured loan. His brother George advanced enormous sums. Other exchange members extended credit on terms that make sense only when the borrower's position is part of the collateral. One example later entered the SEC record through H.G. Wellington, a fellow exchange governor. Wellington's firm made Richard Whitney & Company a 30-day unsecured loan in September 1933. 4 years later, it still had not been repaid. That does not prove Wellington knew about theft. It shows that a former president could remain in a 4-year default on a 30-day loan without the fact automatically becoming a formal exchange alarm. Reputation had become an invisible balance sheet. It delayed the day when anyone demanded the real one. By the time the firm fell, the SEC concluded it had been insolvent for at least 3.5 years. Whitney did not need to make it healthy. He needed enough cash for today's demand. To understand how entrusted property supplied that cash, consider what a broker physically held. A customer might buy stock and leave the certificate with the brokerage firm for safekeeping. A margin customer might deposit more securities than were needed to support a loan. A customer might also leave a cash balance in the account. The broker, therefore, did more than execute a trade. The broker acted like a bank and a custodian. It held cash. It extended credit. It possessed securities that belonged to other people. Possession created opportunity. Imagine a customer leaves a fully paid security in a broker's vault. The broker does not own it, but a desperate broker can take that security to a bank, pledge it as collateral for the firm's own loan, and receive cash. On paper, the customer still sees a security in the account. In the physical world, the certificate may now be supporting somebody else's debt. If the broker survived and returned the certificate before the customer asked for it, the misuse could remain invisible. If the broker failed, the customer discovered that ownership on a statement did not guarantee control over the asset. This was the weakness Richard Whitney exploited. The SEC found that he pledged or used entrusted securities to obtain money for his own purposes and for the failing firm, then tried to replace the property before its absence became visible. He also became entangled with the New York Stock Exchange Gratuity Fund, a pool connected to benefits for the families of deceased members. That incident would expose how far private rescue had gone before formal discipline began. This is why the title's simplest word is the most important. Wall Street trusted him. He was stealing, not from an abstract market, from accounts and institutions that believed custody meant protection. The theft remained hidden from the public. Financial distress did not. Lenders saw overdue loans. Relatives saw repeated emergencies. Banks saw unusual requests for credit. but those pieces had not become one institutional picture. Late in 1937, the warning became harder to dismiss because it involved property tied to the exchange itself. Whitney was a trustee of the gratuity fund. Securities and cash associated with the fund were supposed to be under proper control. The SEC investigation found that property had to be restored. Testimony later described how his brother George borrowed $1,082,000 from fellow Morgan partner Thomas Lamont and advanced money as the missing assets were returned. Meetings followed in November 1937, including a Thanksgiving Day conference among powerful Wall Street figures. Whatever each participant believed he was solving, the effect is clear in the record. Specific property was restored. The wider firm was not subjected to the complete formal examination that would arrive in March. The rescue removed a visible shortage without repairing the system that had produced it. That distinction is the hinge of the story. Returning a missing security answers the immediate custody problem. It does not answer why the trustee moved it, whether he moved other property, whether the firm can meet its debts, or whether the books presented to the exchange describe reality. A rescue can erase the symptom that would have forced the diagnosis. The SEC later condemned an unwritten code of silence around member misconduct. That does not mean every governor knew Whitney was stealing. It means serious information remained fragmented and informally handled. Some people knew about distress. Some knew about special loans. Some knew that fund property had to be replaced. Each could assume he saw a private difficulty, that another insider had the rest under control, or that disclosure itself would damage confidence. The same instinct that once made Whitney useful, protect the institution, calm the crowd, handle the problem inside, now delayed the one thing his firm could not survive: an independent view of the whole. Member firms filed financial questionnaires. The exchange could examine books. Committees could investigate conduct. What the old system lacked was recurring independent verification strong enough to override status. A questionnaire depends on the answer. A scheduled examination lets a firm prepare for the day it will be seen. A private loan has no supervisory value if no rule requires it to be reported and combined with the other warnings. That answers how the exchange missed him. Not because nobody saw anything, and not because Whitney defeated a brilliant control system, but because no mechanism reliably turned what different insiders saw into an independent picture of the whole firm. The primary record is clearer about the final inquiry than it is about the precise rumor or conversation that first set it moving. What can be dated is the institutional change. The exchange's business conduct machinery stopped treating Whitney's condition as a private problem and began assembling evidence about the affairs of his firm. Once that evidence entered a formal process, the protection supplied by Whitney's name disappeared with extraordinary speed. By March 1, 1938, the committee had evidence of conduct that appeared contrary to the exchange's standards. On March 7th, charges were presented to a special meeting of the governing committee. Exchange officials traveled to Washington and informed SEC leadership that evening. The next morning, federal investigators began examining the firm's books. At the exchange, Charles Gay made the rostrum announcement. Richard Whitney and Company was suspended for insolvency. The firm and its general partners filed voluntary bankruptcy petitions that day. For years, Whitney's difficulties had moved through private rooms, personal loans, and quiet conferences. Now every step had a date, a filing, and an audience. The announcement also forced other firms to ask a practical question. Which securities in Whitney's possession actually belonged to Whitney, and which belonged to customers or institutions expecting them back? Bankruptcy converted private confidence into competing legal claims. A certificate that had looked safely held on Monday could become evidence in a fight among creditors on Tuesday. The exchange set a disciplinary hearing for March 17th. Whitney was expelled. 2 partners were suspended for 3 years. Contemporary reporting stressed that they were not found to have known of Whitney's criminal acts, but exchange custom imposed consequences on member partners of the failed firm. Criminal authorities moved separately. Whitney was indicted for first-degree grand larceny involving securities entrusted to him in fiduciary capacities. He pleaded guilty to 2 indictments. There would be no long trial in which Wall Street's private arrangements could remain disputed for months. The man who had argued that the exchange could govern itself admitted the central criminal fact. On April 11th, Judge Owen Bohan sentenced Richard Whitney to concurrent terms of 5 to 10 years in Sing Sing. The judge told him that he had headed what he called the greatest financial institution in the world, and that he had betrayed those advantages. Crowds gathered to see Whitney taken north from Grand Central. The public spectacle reversed the image of 1929. Wall Street scandals usually become visible through paper: an indictment, a bankruptcy schedule, a missing entry. Whitney's departure supplied a human image that no balance sheet could contain. The bow tie, the famous face, the guards, and the prison train turned an internal failure into a national morality play. Then, Whitney had crossed a trading floor as the chosen representative of the banks. Now guards escorted him toward a prison train. Then, his name had been used to create confidence. Now it was replaced by a number: 94,835. Prison completed the fall promised by the thumbnail. But it did not solve the larger problem. Punishing Whitney could not by itself return a customer's certificate, verify a broker's capital, separate a firm's property from a client's property, or make an exchange committee ask the question it had failed to ask. For that, the case had to become more than a scandal. It had to become a design for reform. The SEC opened public hearings in April 1938. Over 14 hearing days in New York and Washington, 52 witnesses testified. The public record filled 937 printed pages and included more than 100 exhibits. The investigation did not ask only which securities Whitney had taken. It examined the structure that surrounded him: outside ventures, customer accounts, special loans, the gratuity fund incident, relations with J.P. Morgan and Company, the exchange's questionnaires, its audits, its disciplinary machinery, and the knowledge held by other men. This shifted the story from morality to mechanism. A court could determine that Whitney committed larceny. The commission wanted to know why a member firm could remain insolvent for years while its senior partner held the exchange's highest offices, and which control would have stopped each part of the scheme. The scale made that question larger than Whitney. By August 1938, NYSE firms reported about $272 million in customer-free credit balances, while the SEC estimated more than $2 billion in securities held in margin accounts. Those brokers were acting as agents, lenders, bankers, and custodians at once. A weakness in firm capital could therefore reach property that belonged to customers. The old system often discovered misuse when a broker could no longer replace what he had moved. Reform had to make the movement visible before failure. The program answered 3 Whitney problems directly. First, he could submit answers without a truly independent view of the firm. The exchange moved toward annual independent audits, more frequent financial statements, and surprise examinations without advance warning. Second, he could overextend the firm and hide dependence on insider credit. The adopted program tightened the relationship between debt and capital using a 15-to-1 ceiling, required reporting of substantial special loans, and restricted speculative margin activity by partners in firms serving the public. Third, he could reach customer property because custody and firm finance were entangled. SEC rules and exchange safeguards restricted rehypothecation and commingling of customer securities. A central depository was studied as a further custody solution, but it was a project under examination, not an instant completed reform. Return to the customer certificate. Under the old weakness, The broker could possess it, pledge it, mix it with other collateral, and hope to replace it before the owner asked. Under the new direction, custody records had to be preserved, use of the security was constrained, independent eyes could count it, and the firm's capital condition could trigger attention before the vault was empty. The answer was layering. If a questionnaire lied, an independent audit might catch it. If a firm borrowed too much, a capital rule created a boundary. If an insider loan arrived, reporting created a record. If customer securities were controlled separately, the broker had less opportunity to use them as private collateral. The final change was governance. The SEC's 1939 annual report said the exchange could no longer be managed or regarded as a private club. It had public obligations. The exchange adopted a new constitution, professionalized management, and added public representatives. The SEC supplied uniform rules and outside authority. The exchange kept responsibility for daily supervision under a structure that could now be inspected and strengthened from outside. This was not a federal takeover. It was an enforced balance between industry self-regulation and commission oversight. Whitney did not create the SEC. The agency already existed. His collapse gave the new regime its perfect test case. The most prestigious defender of self-rule had exposed the exact failure outside oversight was supposed to correct. Richard Whitney served 3 years and 4 months before parole. He left prison in 1941 and later managed a dairy farm, far from the rostrum where his name had moved markets. His public authority did not return. The controls built around his failure did. In 1929, Richard Whitney became valuable because people saw him act with confidence. Lenders, customers, and fellow members kept extending that confidence after the facts beneath it had changed. His final theft was not only the property he misused, it was the gap between what his name promised and what the institution could prove. After Whitney, Wall Street still asked for trust, but had to show more of its work: capital, records, custody, independent audits, surprise examinations, public obligations, and a regulator outside the club. Wall Street trusted him. What replaced Richard Whitney was a system designed to trust no one quite that much again.